Every single day you leave your cash sitting in a standard bank account, you are slowly losing your purchasing power. Inflation is the silent thief destroying your personal savings, meaning investing is no longer just an option, but absolute necessity. You might think the stock market is essentially a rigged casino designed to steal money from average everyday retail investors. But wealthy people know the market is actually the greatest wealth creation machine ever built within human history if utilized. Today, we are going to break down the complex world of investing into simple steps that absolutely anyone can understand. By the end of this comprehensive 12-minute guide, you will have the exact blueprint needed to secure financial futures. Let us start with the most fundamental question of all. What exactly does it mean to invest your own money? Investing simply means putting your capital into assets that have a high probability of growing in value over long periods. The goal is to make your money work tirelessly for you, rather than you working tirelessly for your physical money. The most common and accessible way people build long-term generational wealth is through purchasing shares within the stock market. When you buy a single stock, you are actually purchasing a tiny fractional ownership piece of a real underlying business. If that specific company grows its profits and succeeds over time, the value of your tiny ownership piece increases accordingly. For example, if you buy shares in a technology giant, you financially benefit from every phone or computer they sell. However, buying individual company stocks carries significant financial risk, because if that single business fails, your entire investment could disappear. This introduces the most important concept every single beginner must absolutely understand before investing a dime: the power of diversification. Diversification simply means spreading your invested money across many different companies, industries, and geographic regions to reduce your overall risk. Instead of trying to find the one perfect company, you can invest in hundreds of excellent companies all at once. The easiest and most effective way to instantly achieve massive diversification is by purchasing what is known as index funds. An index fund is essentially a large basket containing small pieces of hundreds or even thousands of different individual companies. The most famous example is the S&P 500, which automatically tracks the 500 largest and successful American businesses. When you invest in an S&P 500 index fund, you instantly own a tiny slice of the American economy. Historically, the broad stock market has returned an average of roughly 10% per year over very long time horizons. While the market constantly goes up and down in the short term, the long-term historical trajectory has been upward. The true secret weapon of successful investors is not timing the market perfectly, but rather leveraging magical compound interest returns. Compound interest happens when the financial returns you earn on your initial investments start generating their own independent financial returns. It's like a snowball rolling down a massive hill, slowly gathering momentum and growing exponentially larger over many years. The earlier you start investing your money, the more time that magical compounding snowball has to grow into massive fortunes. Even investing a very small amount of money every single month can eventually transform into millions of dollars over decades. But what if you are terrified of losing money and want something significantly less volatile than the unpredictable stock market? This is where bonds come into play as a crucial defensive component of any well-balanced and resilient investment portfolio. When you purchase a bond, you are essentially lending your personal cash to a large corporation or a government entity. In exchange for borrowing your money, they legally promise to pay you regular interest payments over a strict set period. Once that specific time period ends, they are legally obligated to return your entire original investment amount back to you. Bonds generally offer lower potential returns compared to stocks, but they provide much-needed stability when the stock market crashes. A smart investor builds a balanced portfolio combining the high growth potential of stocks with the stable safety of bonds. The exact ratio of stocks to bonds in your personal portfolio should depend entirely on your current age and timeline. Younger investors with decades ahead of them can afford to take more risks and hold a higher percentage of stocks. As you slowly approach your retirement years, you should gradually shift more of your money into safer assets like bonds. Now that you understand the basic mechanics of stocks, bonds, and index funds, how do you actually start investing today? The first required step is opening a specialized financial account known as a brokerage account through a reputable online institution. Think of a brokerage account simply as a special type of bank account specifically designed for buying and selling investments. There are many excellent low-cost brokerage platforms available today that completely eliminate trading fees and require no starting balances. Once your new brokerage account is officially open and securely linked to your main bank, you must transfer cash inside. Simply transferring the money is not enough. You must explicitly use that deposited cash to purchase your chosen index funds. Many absolute beginners make the critical mistake of depositing money into their brokerage account and completely forgetting to actually invest. To guarantee your long-term financial success, you need to completely remove human emotion from your ongoing wealth-building process. The absolute best way to eliminate negative emotions and stay perfectly consistent is by automating your monthly investment strategy entirely. You can easily set up automatic transfers that move a specific dollar amount from your checking account into your investments. By automating your investments, you ensure that you are consistently buying assets every single month, regardless of what happens globally. This consistent strategy is known as dollar cost averaging, and it protects you from the stressful psychological trap of timing. When the market is booming, your automatic monthly contribution naturally buys fewer expensive shares of your chosen broad index funds. But when the market crashes in a panic, your exact same monthly contribution buys significantly more shares at discounted prices. Over the course of several decades, this automated dollar cost averaging strategy smooths out the chaotic bumps of the market. Let us quickly discuss the importance of understanding and ruthlessly minimizing the hidden fees that can silently destroy your returns. When choosing your index funds or exchange-traded funds, always check the expense ratio, which is the annual management fee. You want to strictly target passively managed index funds that proudly offer extremely low expense ratios, ideally below 1%. High fees charged by actively managed mutual funds might seem small initially, but they compound negatively against your future wealth. Over a 30-year investing timeline, paying a 1% annual fee could literally cost you hundreds of thousands forever. Another massive wealth killer that you must actively manage and strategically avoid is the significant impact of government annual taxes. Whenever you sell a profitable investment, the government will demand a percentage of your hard-earned financial gains in taxes. To legally minimize these massive tax burdens, you should always maximize your contributions to tax-advantaged retirement accounts before anything. Depending on your specific country of residence, these special accounts offer massive legal tax breaks designed to incentivize long investing. In the United States, utilizing accounts like the Roth IRA or a workplace retirement fund can save you massive penalties. Money grown inside a Roth IRA can eventually be withdrawn during your retirement years completely and utterly tax-free forever. The financial blueprint for beginners is genuinely that simple. Automate low-cost index fund purchases within legally tax-advantaged accounts. The ultimate key to building generational wealth is not superior intelligence, but simply maintaining unwavering patience and extreme long discipline. You will inevitably experience severe market crashes, where your portfolio loses a significant percentage of its visible paper value overnight. During these terrifying economic downturns, the worst possible action you can take is panicking and selling your investments at bottom. Successful, wealthy investors view market crashes not as a tragedy, but as a phenomenal opportunity to buy good assets cheaply. Always remember that you only permanently lock in a financial loss if you actually sell your depreciated assets during panics. If you hold strong, stay patient, and continue buying consistently, the market will eventually recover and climb to new highs. Investing should be boring, incredibly predictable, and entirely disconnected from the daily sensationalized panic spread by mainstream financial news media. Your future self will deeply thank you for making the incredibly wise decision to start building your wealth right now. Do not wait for the perfect moment or the perfect economy to begin investing, because the perfect moment never arrives. The absolute best time to plant a strong financial tree was 20 years ago. The second best time is today. Take action immediately. Open your brokerage account this week, automate your first monthly deposit, and let market compounding do everything. I hope this comprehensive beginner guide has successfully demystified the stock market and empowered you to begin your financial journey. If you found this 12-minute investment blueprint valuable, please drop a like below to help push this content outwards. Make sure to subscribe to the channel and turn on all notifications so you never miss our future financial guides. Thank you so much for watching this video today, and I will see you again in the very next episode.